week's market update. Jerome Powell's interest rate policy is in the spotlight, a crucial week for Brexit, the FTSE reshuffles, and bear market signals, how many are flashing red. Jerome Powell is in the spotlight this week as he faced his first congressional hearing on Tuesday. This provided the first opportunity for him to flesh out his interest rate thinking since taking over as chairman of the Federal Reserve from Janet Yellen. His first week in the job coincided with the worst of the recent market turbulence, so it was interesting that he appeared to sweep aside the impact of market volatility as an influence on the Fed's deliberations. Rather, he confirmed the view that the Fed is increasingly convinced of the strength of the US economy and believes that tax cuts and more fiscal spending in the US might actually require policy to tighten at a slightly faster rate than previously thought. The dollar was stronger after Mr. Powell's testimony, and stock markets a bit weaker as the prospect of interest rates rising further and sooner was absorbed by investors. The debate underway at the Fed and other central banks is whether the recent synchronized global upturn might lift the so-called neutral rate for interest rates. That's the level at which monetary policy neither stimulates nor holds back activity. Since the financial crisis, the neutral rate has come down as the Fed has become more pessimistic about the economy's potential. If it now starts to rise, this could give the Fed more room to raise rates further than expected. It would probably welcome this flexibility because it would provide more firepower to cut rates during the next downturn. One of the big fears about permanently low interest rates is that they take away a key policy tool for central banks. But, of course, higher than expected rates might equally be taken badly by the stock market, which has become used to very low rates for nearly 10 years now. It's not just the Fed which is thinking about the neutral interest rate. Here too, Governor Mark Carney has warned that a rising neutral rate means that even flat interest rates might be giving the economy more stimulus than required. The UK and US situations are of course quite different. The US is benefiting from tax cuts, adding fuel to an already smouldering economic fire. That argues for higher interest rates. Britain, meanwhile, is still struggling with Brexit uncertainty, and that might argue for continuing caution. Brexit is very much the main focus on this side of the Atlantic this week, as the leaders of both main parties make key speeches in which they will set out differing positions on whether Britain should remain within a customs union with the rest of the EU after the UK leaves the single market. Labour leader Jeremy Corbyn on Monday swallowed his own personal Euroscepticism and committed to keeping Britain within a single trading bloc. That marks an important shift in policy by the opposition party and creates a major headache for Prime Minister Theresa May. She's sticking with the government's line that Britain will leave both the single market and the customs union. Remaining in a customs union would ensure no new tariffs when trading with EU countries, and crucially would avoid a hard border with customs checks between the Republic of Ireland and Northern Ireland. It would, however, leave the UK unable to negotiate its own trade deals with other countries, so crossing one of the Brexiteers' own red lines. With no parliamentary majority for leaving the customs union, Labour's shift towards a softer Brexit could embolden Tory rebels to vote against their own party. This could be crunch time for the PM, who will set out her position in a speech on Friday. That is expected to set out a cherry-picking approach to regulatory alignment with the EU. Some industries, notably those like cars and aerospace, which have complicated pan-European supply chains, would keep full alignment with EU rules. A second group would see Britain adopting comparable or equivalent rules, and a third group would see us go our own way. This compromise position is designed to keep both sides of the cabinet on side. It was the fudge agreed at last week's so-called away day at Chequers, hosted by the Prime Minister. But it is seen as very unlikely to be acceptable to the rest of the EU. If Tory Remainers and Labour join forces to support membership of the customs union, the plan may not even get as far as being negotiated with our European partners. It's unlikely that either of this week's speeches will have a huge market impact, as investors have become resigned to a period of continuing uncertainty on Brexit. The markets have long since moved on from politics as a key influence after a year in which most European elections failed to deliver the anti-establishment victories that many feared after Brexit and the election of Donald Trump. The next in that series, in Italy this weekend, does still have the potential to cause an upset. Italians go to the polls on Sunday for a general election that is the most unpredictable in years. It looks like being a three-way race between a right-wing coalition led by Silvio Berlusconi, the incumbent centre-left candidate Matteo Renzi, and the wildcard entrant, the Five Star Movement. The result will be influenced by Italy's sluggish economy and, of course, the wave of migrants arriving on the country's shores in the past few years. Now, politics may have slipped into the background, but big question marks still remain over markets. The recent volatility soon calmed down, but investors remain nervous about whether the market's gyrations in early February were a one-off or the precursor of a full-fledged bear market. Robert Buckland, the chief global strategist at Citi, has a bear market checklist of signs that he monitors to determine the likelihood of a sharp fall in markets. He remains relaxed, saying that only 4 out of 18 signals are currently flashing red. He thinks particularly that valuations are unattractive and he worries that corporate balance sheets are stretched. But he doesn't see chief executives behaving as they usually do at the top of the market. Capital expenditure, takeovers, IPOs, they're all pretty subdued. Inflows into equity funds are picking up, but they're still low compared with previous peaks. And he thinks that a second year of synchronized expansion will be enough to lift markets a bit further. However, he's with the consensus when it comes to volatility. He expects more of it this year, in line with previous cycles when equities rose towards the end of the cycle, but in a more volatile way. And the things he worries about most? Well, first, a downward sloping yield curve. That means that short-term interest rates are higher than the yields on longer-dated bonds, and it suggests that investors think the central bank is leaning too heavily on the economy and will cause a recession. Second, he worries about high credit spreads. The corporate bond market is usually seen as a canary in the coal mine, and a big gap between the yields on government bonds and those on corporate debts is a sign that company defaults might rise soon. Now, neither of these are in place at the moment, but they are the things to watch as the final, sometimes exuberant phase of the stock market cycle gets underway. If volatility does pick up, then some investors are likely to be disappointed by the recent performance of so-called low volatility funds. These are designed to protect investors from volatility, but thanks to their exposure to some of the bond-like stocks that have done so well in recent years, they suffered when investors started to question whether the outperformance of the growth style could continue unchecked. Low volatility funds are vulnerable to interest rate rises because they're heavily weighted to sectors like utilities, which look less attractive to investors when the yield on safe investments like cash and government bonds rises. They were punished in the recent correction. That correction looks likely to leave US stocks posting their first monthly decline for 11 months. By Monday's close, the S&P 500 was 1.6% down since the start of February, and it fell a bit further yesterday, and it was 4% up by the year to date. Only the technology sector managed a positive return in February. It rose 1.6% and is up 9.2% year to date. Companies that could be punished later this week for recent underperformance are those that will be kicked out of the FTSE 100 at the latest quarterly reshuffle of the blue chip index. Every 3 months, the index automatically removes any companies which have fallen in value by enough to rank them 111th or below in terms of market capitalization. Any company in the FTSE 250 which has risen in value by enough to be ranked 89th or higher is also automatically promoted. Any relegations are then replaced by the highest ranking 250 stock, and promotions replace the lowest ranked 100 stock. The expected demotions this quarter on the basis of today's closing share prices are Hammerson, although its imminent merger with rival Into will probably see it re-promoted in due course, and security services group G4S. They will most likely be replaced by Royal Mail and Weir Group. And finally, Warren Buffett's letter to shareholders in Berkshire Hathaway arrived on Saturday. In it, he said that US tax reforms had been worth $29 billion to the sprawling conglomerate. But he also said that he was finding it harder and harder to find the big acquisitions that might make a difference. He said deals were being made at far too expensive valuations, and unwilling to get into a bidding war with less prudent investors, Berkshire Hathaway is, as a result, sitting on a $116 billion cash pile.